I'm Debra Beck-Mewing, and I'm from the Property Frontline.
I'm Ken from Avvora Finance.
And I'm Gilmovich from Real Property Manager. And welcome to Property Mythbusters. And we're here, of course, to bust the myths around the contradictions and misleading information in the property investing landscape. And for the next 10 minutes, we're going to be continuing on our series on the COVID-19 marketplace. And you'll hear from the three of us looking into the rental market, the lending and finance market, and of course the purchasing and sales market. So Deborah, let's have a look at the latest rental figures, and have a look at what's going on in the rental market since we last spoke. Now, as a on-the-ground practitioner, and not just a theorist, I'm pretty much in tune and in touch with the rental market space, in particular my local market, the inner Sydney metro area. So pretty much the theme at the moment, and the latest stats and trend has pretty much been the case for the last 7 or 8 weeks, and that is a downward pressure on the actual rental prices. And if you look at the national figures there, most you'll find are in the red, with a scope of about 5 to 7% change across the asking rents, and that is simply as a result of the ongoing oversupply situation. And as opposed to last year, where we were hovering around 1.8 to about 2.2% vacancy rates, it is pretty clear. We can see here, it's the last possible statistics that we have here from SQM research. We're heading towards a 4% vacancy rate in Sydney in particular, and then our other major capitals, we're heading towards a 3% mark.
Sorry.
Now,
sorry, here. So you're talking about this?
That's correct. Yeah.
Oh, yeah.
Yeah. So Sydney is obviously a standout with almost 4% vacancy rate, and I'm expecting that to increase over the next few months as well. And there's a reason for that, and we'll go to the next graph and have a look at that. But the overall trend at the moment is generally a higher vacancy than usual. At around the 3% mark is where, as a rule of thumb, supply equals demand. So we're just tipping over. We're tipping over in Sydney to that point where there's just not enough tenants because our borders are closed. Tenants are generally not moving for several reasons, including cost of moving, simple fact that also they've renegotiated their current rents with their landlords where they are at the moment, so they're staying put where they are because they've got a better deal, rather than risk going back out to the marketplace, and the cost of moving as well. And job security, of course, plays a big part in that as well. You know, when times are lean and tough, and unemployment is heading in a north direction, people are making those big decisions, especially financial decisions that they need to make. So if we look at I mean, the big one for me is the CBD. If we go back, Deborah, to that graph where the CBD vacancy, that's a skyrocketing figure there for Sydney, at 13.8% vacancy rate. The CBD of Sydney is absolutely getting smashed at the moment with rents, and I know some cases where there has been falls up to 40 to 45% last year's asking prices. I know that for a fact.
Yeah, because a good vacancy rate is like around about 2.5%, isn't it?
Under 3%, that's a low risk environment for me. If we're hovering around that over 3.2, 3.5%, we're heading towards the 4% mark. That's a riskier proposition for investors.
Yeah. Okay. Yeah. So 13%, nearly 14% is outrageous.
Yeah, very risky to purchase an investment property right now around the a CBD area, unless you can actually withstand potentially having a vacant property for up to 6 to 8 weeks and sacrificing on the asking prices, because it's basically investor versus investor competing with each other for the limited amount of tenants that are actually in the marketplace for a CBD property. Given the fact that they're working from home, and a lot of businesses are not having their staff back on full deck in the CBD offices, and they may not for the next 18 months to 2 years because the working environment has just completely changed. We may not see that for some time.
But that's largely units, isn't it, John?
It's mainly apartments. Yes, apartments are generally the most affected, as well as all those properties that were on the short-term rental market as well.
Airbnb.
Those Airbnb, corporate leasing, and of course hotels. Hotels are also competing at the moment at offering weekly rates for long-term tenancies, believe it or not.
Yeah,
so you've got all that supply, and hence the double figure vacancy rates there heading towards 14%.
Yeah. Okay. And so, did you want to have just a quick look at this one? So this is. Yeah.
So on the good note, as we were peaking during the peak of the COVID situation around that late March, April, you can see the dip there on the 1st of April of inquiry rates. These are the searches on realestate.com for rental property. It's taken a dip, but as we're coming out and things are being more relaxed, and the social distancing and restrictions of trade and businesses are getting a little bit back to normal, we can see the confidence levels are starting to go up here through June, where we are now, and people are starting to search and get back into the rental market and starting to think about making a move. And I'm definitely seeing that down on the ground in the marketplace, where open houses, which we've been restricted to for the last 8 weeks, we're back to doing open homes, and those are generally being well attended. So we are seeing those tenants come back into the marketplace, starting to inspect. They may not be ready right this second to sign a lease, but they're not far away. They're 3 to 4 weeks out generally in the cycle. In the rental cycle, people are generally around about 3 to 4 weeks out from making a move into their new home. And of course, they're also looking out for the bargains, because there are a few out there. There are heavily discounted rental properties available, so they're pouncing on that opportunity, and you can see that from a data sense that they're starting to as the health predicament of the COVID is starting to get under control, the confidence is coming back, and they're willing and able to make a move.
Yeah. Okay, that sounds good. Alrighty, so Ken, over to you. What's happening from the finance side?
Just to kind of follow on, I guess, from what John was saying about the people being out and about and things like that, because I do attend open homes in the Auburn, Lidcombe, that kind of area every Saturday once the restrictions were lifted for open homes to resume. There's certainly a lot of people out and about looking for purchases. The inquiries for making purchases as well has come back. It kind of died down quite a bit during the pandemic, but yeah, there's a healthy volume, and that's kind of reflected in the lenders' assessment times on how long they take. The majors seem to be struggling a little bit in terms of processing home loan applications, and they're kind of handling it in different ways. Some are kind of doing a triage, prioritizing purchases first as opposed to refinances. But it's actually interesting the types of buyers that are out there at the moment. It looks like investors aren't, there isn't too much demand for home loans from investors. So going back to that,
yeah, right.
Thanks. So this is the graph that was that's been provided by the RBA.
Yeah.
And the one thing to note here that the timescale, I guess, is quite long. We're looking at a 16-year window from 2004 to 2020. So looking at some of the actions that's happened more recently, we're probably looking at the ending, the tail bit of that graph there. You can see that primarily the home loan commitments, the demand for home loans has been driven primarily by owner-occupiers. Investors are probably still a little bit cautious, probably coming off the back of a lot of things that you were saying, John, where the rental market isn't that strong, so return on investment, etc. Feasibility on interest rates are fantastic. Very competitive compared to where they were 15, 20 years ago. But yeah, it's just that uncertainty. So I think there's also other hurdles for investors if they are looking to apply for a home loan because of the shading of rental income. Used to be 80, some of them are 70, some even, there are some other calculations that go on which may mean that they use less of the rental income. But yeah, at the moment it seems like it's primarily driven by owner occupiers. But there's also a substantial amount of,
What's happening with pre-approvals? Because I've heard different things speaking to my clients. Some have said that they've got like a rolling 30-day approval, and some have come back saying, I can't get pre-approval. The bank just said, come back.
The bank comes back and says?
No, the bank has just said, come back when you're ready. Like they're not giving out pre-approvals.
So one of the small lenders did stop pre-approvals. There were a few others because prior to the whole the virus and the pandemic, there was question marks around feasibility on doing pre-approvals because it cost them to assess. A lot of times the pre-approvals don't move on to an actual home loan or purchase or settlement. So from a commercial point of view, from the lender's commercial point of view, like they're just doing a lot of work and not seeing a lot of them translate into funding loans and then of course generating income from there. So yeah, there were a couple of revisions. There was another a major online lender who kind of changed the way that they assess it. Instead of going to a physical assessor, they use automated systems to do that. So yeah, I haven't seen a whole, put it this way, it'll be based on, it's not a trend or a general move by lenders. I know that there was always in the background, some were thinking about it, some weren't, some, it's business as usual. So yeah, it is possible that could happen because it could be a mixed result because it is a mixed kind of situation where some are fine, some aren't, etc. Whether the majors would be focusing on pre-approvals, I don't know. Maybe they'd probably prioritize purchases, signed contracts of sale, as opposed to pre-approvals. And in terms of the rolling one, no, I haven't come across a rolling one yet. It wouldn't be. I mean, usually they kind of do it for 90 days, right?
Yeah. Okay.
So yeah, the applications that I've seen, they're still doing the standard 90 days. And basically, there's just a couple of more questions around income, whether there's been any changes to income, updated pay slips, making sure that, it's supporting documents like the bank statements showing that the salary credits are going in because things can change on a dime if the employer was to cut hours and things like that to maintain cash flow. But that was probably more prior to easing of all the restrictions. So it is possible, and not all pre-approvals are the same. I was actually having this conversation with a client this morning. So not all pre-approvals are the same. Some go through an automated system where, you know, if you say your income's 140,000, they'll take it at face value, and then, you know, they may go through more thorough or detailed checks and then cover, you know, deductions, tax, maybe fringe benefit stuff, additional loading, stuff like that, which may skew the calculations because they might not take the full 140,000. They might, you know, take the base pay and then a percentage of your loadings and things like that. Whereas other lenders actually do it, I wouldn't say properly, but they do it more thoroughly, where they actually go through and assess everything, make sure that all the documents line up, bank statements, pay slips. So they're really, I guess, assessing as much as they can. The only thing that's left is the property. They don't know what the property is going to be like, whether they will accept the security or not. So that's something to take into consideration when looking at. So speed, I think at the moment, speed is probably going to be a critical item for people to kind of consider. Some of the majors are looking at like 36 days just to pick up an application. Yeah, 36 days. Like, I'm not like, it's, and in 15 days to pick up an application for another one. So like, it's substantially long, whereas there's other lenders who will turn it around in a day. So depending on the situation and what the applicant's wanting to do or how quickly they're wanting to move, sometimes it's fine, sometimes it's not. Sometimes you are tethered to a particular lender because of existing lending and stuff like that, for various reasons. But yeah, at the moment, investors not so. Owner-occupiers are definitely leading the charge in terms of demand for home loans. So that's all from me.
Well, thanks, Ken, for the update there. Very interestingly, I mean, since we last spoke a fortnight ago, of course, there's been a rollout of another government stimulus in the way of the home building $25,000 K grant. Debra, is the phone running off the hook?
Well, yes, the grants have actually had the desired effect, even for people who don't qualify for the grants. So just to be clear, there's the Home Builder Grant is a federal grant over the top of all the existing grants. So that means that in some cases, buyers can access upwards of $50,000. In WA, you can get something like $70,000 in grants. So that's for building new. But on Friday, so Friday the 5th of June, the Home Builder component part 2 is also for renovators. So if you have a property and you're considering renovating and your project was going to cost more than $150,000, you can also access $25,000 grant if you get the project done within or before the end of the year, so before the end of 2020. So we were actually starting to see a pickup in demand, so buyer interest. That was actually building through May, and then towards the end of May, I really felt it pick up once kids went back to school, and then once the announcement came out about the grants, it's kind of like confidence is back, and even all the agents are saying, oh my God, like where did all these buyers come from? And let's have a look at a couple of graphs to see some trends. So let's see if I can get the graph I want here. So this is a really cool series that realestate.com has started to publish, and similar to the rental activity, so this is tracking search activity on realestate.com. So you see this massive dip, historic dip, down to bottomed out on the 1st of April, and then ricocheted back up to outstanding activity. So when you look at this graph over a longer period of time, you can actually see, and even it shows here, that when the market was particularly hot, which was just pre-COVID, so you know, January, February of 2020. So now buyer activity on this particular platform is 20% higher than at the peak of the market. So this is obviously translating into certain properties really maintaining their price, or you know, doing much better because we haven't got too much supply on the market. So there's something like only like about 400. Let's see if I can get this in front of me. So SQM auction. So this is a summary of auction activity up until the 9th of June, so just a couple of days ago, and just reports on the past week's actions. So the number of auctions that were advertised last weekend was around about 400 for Sydney, just under 200 for Melbourne. These numbers are at historical lows, but the auction clearance rates are also slowing. So when we've got a seller's market, you're looking at like around about 55 to 60% clearance rate. That's when we'll see prices really sort of ramp up. So it's still a buyer's market kind of status, but these numbers, because they're on such, you know, low comparables, it's not really telling the true story. So there's a lot more private sales, and of course, same old story in that good property you still have to fight for. I won't mince on too much about that. Generally, we're also starting to see now the bank forecasters. I really don't, you know, I don't rate their forecasting, but people like UBS released a revision to their market forecast for property pricing over the next 6 to 12 months, and they have revised their forecast now to saying they expect generally the market to be down by around about 5%, between 5 and 10%, where prior to that they were saying they were expecting much bigger drops. But you know, as I said before, in Australia we have thousands and thousands of markets and everything moves differently. The other thing I wanted to show you was another graph that REA have been developing, and so this is about a more intricate indication of buyer demand and interest. And so this is the national view. So nationally, they're showing that buyer more and intentions to purchase have been hardening. So, you know, a higher intention to purchase, but it's now starting to flatten out a bit. But from my perspective, that was just due to the long weekend, things slowing down. So I expect that to continue upwards. So I guess that's it from me, but what I did want to do was make just a little comment about the federal grants. If you are considering buying, whether it is an investment property or your home, be very, very careful about just running after those grants, because it could lead you down a pathway that's probably not best for you. I find it really, really difficult to scenario out a buyer who would do well by using the grants, only someone who couldn't actually get a property any other way. So if you can't save, maybe the grants are for you. If you do have a good saving record and can put together a good deposit, or even just a 10% deposit. Actually, I should ask Ken about that. But anyway, if you can pull together a deposit, you're probably better off ditching the grants, because you can buy really good property in established suburbs closer to well-established infrastructure for even like about 600,000 in Sydney, and you'll be buying a property that you can actually see, walk in and touch and measure, and it will typically be on a bigger block, which will mean it has opportunities for you to do something to add value and equity in the future, rather than buying something that's on a tiny block in a really broad outer suburb where you have to wait probably years for good infrastructure like rail, schools, hospitals to actually reach you. And plus those properties, those brand new properties where the grants apply, they are attracting a premium price. So you might be looking at, say, a purchase of about 700, or grant tops out at 750,000, where in established suburbs you'll be able to get something for 600,000. So you're saving heaps of money. Anyway, I know I have to be a little bit distinct about that, but just one more question before we go. So Ken, what's actually happening with the deposits? So can people buy, if it's a home purchase, can they buy well without, with just a 5% deposit, or? I can't hear you. No. Speak up a bit.
No.
Oh, that's better. Yeah.
Haven't there, but yeah. Look, they said that they're going to release another 10,000 first home loan deposit scheme come the end of the month. So that's still an option for people who are interested in buying their own home. All the spots are filled up from the I wouldn't say from the non-major lenders. I think there were still a few spots available from the majors, but I think CBA had capped out on their quota last time I checked.
But what's happening with, like, can you buy a property with just 5% deposit these days?
If the numbers stack and your circumstances, so yes, you can. And the way that it would work is you do your 5% deposit. You need to qualify for your first home buyer's grant in New South Wales anyway, to not have to pay stamp duty, and there's parameters around that. So there's thresholds in terms of how much the properties can be worth, otherwise you will need to pay stamp duty. And the other thing is that, you qualify for the first home loan deposit scheme. So that addresses the lender's mortgage insurance. Because lender's mortgage insurance, let's just say for a $650,000 property, which is an entry-level kind of price, I guess. Stamp duty could be, 20, 25,000, just very roughly. And then lender's mortgage insurance, if you're going up to 95% LVR, could be about the same as well, 20, 23,000, something like that. So straight up, the cost is 50,000 just to pay for the transaction costs, which is, a substantial amount. So you do need to qualify for those two things. There's also criteria to qualify for the first home loan deposit scheme. And if you jump through all those hoops and then the credit policies on top of that from the specific lender themselves, then you can. So it's possible.
Okay. All right. Okay, well, I know we're really starting to run over time. So thanks very much for watching. We'd love your feedback. So please join the Property Mythbusters Facebook group, or if you have questions that each of us you can contact us through our social channels or through our direct websites. So that would be john@realpropertymanager.com.au, ken at Avvora, .com.au, or me at thepropertyfrontline.com.au. Thank you.